Hello everyone, welcome back to PhillipCapital's Market Watch. I'm Jack from PhillipCapital Contract for Difference. Today I'm going to discuss why I believe a recession is likely to happen. And at the end of the video, I will share my insights on what we should do during a recession. When we look at the US economy right now, it seems like it's doing so well. Inflation went down to 3% from its peak. Job market and unemployment rate are also at a healthy level. Although these are strong confirmatory signals that a recession is unlikely. But today, I would like to share something that might change your view on the economics. In fact, we see some hidden risks lying ahead in the economics. This including the major strike in the automotive industries, students starting to pay their loan, and the oil price spiking up. All these events could dampen the economics and cause significant disruptions. In the most unfortunate situations where all these events happen at the same time, it could be enough to push the US into downturn as early as next year. Some people might point out that the stocks market is performing well and the housing market is strong. But it is important to remember that these favorable conditions can change rapidly in a high interest rate environment. Changes in interest rate also impact the job market, although their effect may not be immediately noticeable. Why do we say that the probabilities of a recession is going up? As we are monitoring several data indicators and have observed some red flags that signals potential economic challenges are heading our way. Let me introduce you to the two data indicators I personally look at. First, there is the inverted yield curve, one of the most famous and commonly used indicators among economists, which has a history associations with recessions. An inverted yield curve occurs when short-term interest rates are higher than long-term interest rates. These inversions can suggest that investors are worried about the near-term economic outlook, which may be a sign of an impending recession. In fact, since World War II, every occurrence of a yield curve inversion has been followed by a recession within the next 6 to 18 months, referring to this graph, which displays the difference between the 10-year Treasury constant maturities and 2-year Treasury constant maturities. A common way to monitor the yield curve for potential recession signals. When the line dips below zero, it is a strong indicator that a recession may occur. From the 5 points on the chart, we see that the observations hold, where each dip is followed by a shaded gray area used to represent a recession. Hence, there's a correlationship between the inversions of the yield curve and economic recessions. Thus, we should exercise caution during this period when economic indicators are suggesting a higher likelihood of recessions. Now, let us explore the second crucial indicator called the leading index. This index functions like an early warning signal for the economy, giving us a heads up about potential changes in economic conditions. The leading index consists of 10 indicators, including average weekly working hours in the manufacturing sectors, jobless claim, manufacturing PMI, building permits for new private housing units, S&P 500 stocks price, and more. These indicators provide a comprehensive view of various aspects of the economics, making the leading index a valuable tool for predicting economic trends. It helps us understand the health of different sectors from employment to manufacturing and housing, and even stocks market performance. Referring to the graph, every time the leading index goes down, it is like a warning sign, hinting the recessions might be on the way. Currently, the leading index has been going down since the start of the year. It can be seen as an early warning sign that the US economy might face recessionary conditions in the near future. It is a crucial tool for forecasting economic trends and taking proactive measures to address potential challenges. So, what should we do during a recession? It is important to take proactive steps to protect your investments and make the best of such a challenging economic situation. A recession should actually be seen as an opportunity to re-evaluate your goal and make a necessary adjustment. In recessions, we should consider our long-term financial goals and plan our roadmap to achieve them. Set your goal and make sound investment choices that will benefit you in the future. Avoid volatility's growth stocks and focus on sectors that tend to be less affected by economic downturns. One good example is the defensive stock which are shares of companies that provide goods and services that are necessities. They tend to be more resilient and can provide a level of stability during turbulence time. Investing in defensive stock can help mitigate the impact of economic downturns on your portfolio. However, it is essential to do your due diligence and consider your investment goal before making investment decisions. Recession can have far-reaching effects on individuals, businesses, and the overall economics. Understanding the sign and getting prepared can help us to navigate this challenging time. It is essential to build emergency fund and diversify your investments. Lastly, seeking professional advice can also be valuable strategy for ensuring financial stability. While recessions bring economic challenges, they also present opportunity. So stay informed, adapting to changing circumstances, and making well-informed choices are key to weathering the storm and emerging from a recession. With that, I would like to end this segment of Phillip Capital Market Watch. Do remember to like the video, subscribe to our channels on YouTube, and follow us on social media handles. Thanks for joining us and see you soon.